Good morning. It's Friday, March 6th. Here's what's on the agenda. Global stocks recover even as the Middle East war rages on. The US greenlights Indian imports of Russian oil, and Trump officials mull permits for AI chip sales.
Lizzy, markets looking ahead to a more positive take for equities globally today. It seems as if European equity markets will be very much on the front foot this morning. US futures pointing slightly higher. Both of those sides of the Atlantic trying to recoup some of the losses of yesterday. Brent crude has been fluctuating. Lots of really interesting news flow surrounding what the US administration might do and India. But we watched that down by 0.1%. 85.27 is where we trade on Brent crude. Gold hasn't been much of a haven. We'll talk more about that in a moment. It jumped on Monday, dropped on Tuesday, hasn't really recovered from that. Today we see it up by 0.6%, over $5,000. A troy ounce, the countdown to the opening trade starts right now.
Happy Friday, everyone. So we check in on the markets, of course, of the moment. But you look back across the week, Anna and Lizzy, and what you see is a mixed picture. The clearest trade in terms of the safe haven has been the US dollar. If you take a look back at the equity story, it's Asia that has fared the worst, down about 6% over the last week. Then Europe down about 3%. And the most resilient is the US equity market, down about 1%. That's where the resilience has lied, in the US dollar and relatively in US equities. But the other havens have not performed their role. Yeah. And remarkably, you look at gold over the week, down 4%. The Swissy has not played a role. The yen has not played a role. It seems to be about the dollar and about US equities. The question for me is, how do you trade in and leading up to this weekend, given what could happen? Do you be staying on the sidelines? How do you position after the week that we've had? Yeah. And do those haven trades change and adjust as we look at a conflict that seems to see both sides digging in ever deeper? Yeah, it's really interesting. We've got that haven check on the screens right now, showing what's happened over the past week. And you can clearly see that bonds have not been a haven. You can see that the dollar has been, but the yen and the Swiss franc have not been. And you can see that gold has not played the haven role that you would expect it to. I guess gold makes more sense in that there'd been such a run-up in gold leading up to this, and it is very liquid, and so some people have suggested, in times of acute stress, you do see actually it pulling back. But some of the other FX conversations, we're going to talk about that a little bit later on in the programme, because I'm really intrigued as to just how resilient the dollar can be here. What are the levers that change that, if any? What creates more of a link between what's going on in the Middle East and a negative dollar?
But as you say, Tom, how do you position going into the weekend? Because it's always the weekend when things seem to happen with President Trump, and neither side seems to be backing down in this conflict. You've had Iran launching a fresh wave of missile and drone strikes across the Gulf over the past 24 hours, showing that Tehran can still hit multiple targets simultaneously across the region. It's further depleting the supplies of missile interceptors. And earlier this week, we had that conversation about the economics of this. It costs more to defend against these than it does to launch them. And the solution to that is still in the pipeline. For the US, President Trump talking about wanting to clean out Iran's leadership structure and insisting on being personally involved in picking that leader. But that seems to just anger Iran even more. Now, for markets, the fear remains that the energy shock turns into an inflation crisis. We had a redhead this morning that Strait of Hormuz shipping traffic's at a near total halt. And when it comes to oil, to keep oil flowing, the US exploring a range of options, as you say, Anna, to get that going. So granting this 30-day waiver to India to get those Russian oil imports. And this seems to be a quick fix because you've got 15 million barrels, more than, of Russian oil just floating around. But analysts saying this won't be much of a game changer in terms of prices. Yeah, we've been asking since Monday, is India going to start buying Russian oil? Because that seemed to be one of the levers that very much at the margin might reduce the pressure. And when we got news that the US was going to grant this waiver, we did see a little bit of a dip in the oil price, but then that's come back. That's been unwound a little bit. We are down 0.4%, but we're still at $85, so it's not moved all that far. And yes, ING saying this isn't a huge game changer without reopening the Straits of Hormuz.
That's the only thing that's really going to change this. And that isn't just a question of insurance, as we talked about with the shipping industry at the beginning of this week or middle of this week. And I was hearing yesterday Rabobank talking about this. You know, captains on ships have rights of refusal. If they don't think it is safe, they won't go through.
And we had a further reminder of that today in terms of the effective closure of the Straits of Hormuz and the fact that it will take weeks. That is the expectation if you have a naval capacity in the Straits of Hormuz to reopen, of course, that. And we know the conversations continue, it seems, in the Trump administration around those options. These temporary licenses of India, they run out on April the 4th. It's another reminder that to some extent Russia is gaining on the back of this conflict. Its oil is now being purchased and will be purchased by India. It's not just oil. We've been thinking about the gas price, of course, and what's happening in terms of LNG and the inability for Qatar to ship most of that to its exported and main customers. We got some analysis from one of our opinion writers on the terminal today talking about the fact that Taiwan and South Korea are very, very dependent on LNG. And when we think about Taiwan, of course, and South Korea, you think about the chip-making capacity there. And talking of chips, we have this news that the Trump administration, being reported from our team, has actually drawn up proposals when it comes to chips, AI accelerators, so think Nvidia and AMD, to potentially have significant leverage in terms of how and when those are shipped to other countries. Basically wanting to be stepping in, particularly if there are large numbers of these chips being bought. 200,000, for example, a cluster of 200,000 chips would involve a sovereign nation having to negotiate with the US and might even involve US officials on the ground. It's just a reminder of a Trump administration looking for leverage. And if you're sitting on the other side of the US, you have to wonder how much leverage they now have when it comes to access to these crucial components. The only other country really that can supply these is China.
Yeah, absolutely. So how the US would use this lever if it applies it more widely, because it already has rules in place for 40 countries, doesn't it, about not shipping chips or very much controlling how much of these accelerated chips are sent. But now this would be much wider. And so it would even raise the question for allies, how much would the Trump administration, as we've seen them use all kinds of trade tools, how much would they use this tool in other areas of policy to try and leverage to get what they want? I mean, it is worth saying that this is just a draft and it might not come to pass, but this is what is being discussed in Washington.
And it's nonetheless the most substantive step towards a global chip export strategy since they scrapped Joe Biden's approach in May. Basically, Washington wanting to be the gatekeeper to the AI industry. As you say, we don't know how far Trump is going to use this as part of his broader trade strategy, but we know how important export controls have been in the US-China trade war so far.
Yeah, really interesting that, China is sort of a separate issue, isn't it? It's got its own regime around how many can go to China. The Nvidia rules have been in place there and recently lightened up, but we haven't seen a huge amount of demand necessarily for those
we'll see if there is this meeting that is expected between President Trump and President Xi Jinping, whether they get further clarity on that, because we know that has been moving in a direction where China can start to import some of these Nvidia chips. But so far, there haven't been significant shipments into the Chinese markets, but that could change, of course, on the back of this meeting.
But already Nvidia and AMD shares falling off the back of this.
Yeah, they did in session.
Suggestion.
Let's tell you what's coming up in the programme in terms of the guest conversations we're going to have. Sam Linton-Brown joins us. BNP Paribas Markets 360, Global Head of Macro Strategy. 7 days into this war, what kind of impact is he seeing across assets? Sonia Martin will be with us. Lots of FX conversations to be had. Why didn't the yen and the Swiss franc behave as you might have expected them to? What other complexities lie behind that? We'll also talk to Karen Georges, who's EcoFi portfolio manager, about the broad markets, equity markets, very divergent, different parts of the world, as Tom was saying. And we'll talk to Carl Pei. He is the CEO of Nothing. That is a consumer conversation, a supply chain conversation, telecoms conversation at the end of the programme.
Well, let's look ahead to what else we're looking out for today. The Canadian Prime Minister, Mark Carney, is in Japan, so we'll look forward to hearing from him. Then at 10 a.m. London time, we get Euro area GDP numbers. Then 1:30 p.m. London time, we get the US jobs report, non-farm payrolls and unemployment part of that. This clearly the data highlight of the week. And then at 5 p.m, we hear from the ECB's Isabel Schnabel speaking at the Monetary Policy Forum in New York, as well as Fed speakers, Daly, Paulson and Hammock, all speaking at that event too. But as I say, the jobs data, clearly the highlight. Unemployment expected to hold at 4.3% in February. Non-farm payrolls, I've checked out the Whisper number this morning, 65k, so higher than the survey number, 55k. But really, we've been talking all week about the US-Iran war. Could this take the focus back to the job side of the Fed's mandate, when we've been seeing the Fed bets changing so much because of the inflation impact of the energy crisis?
At the beginning of the week, it very much felt like, well, certainly in Europe at the beginning of the week, nothing else was cutting through. But as we've gone through the week, and certainly stateside, some of the data has cut through and has had an impact. And we heard Michelle Bowman just yesterday talking about seeing a stabilising labour market since the beginning of this year. And this obviously will all be very important to those watching that March and ongoing Fed decisions.
And jobless claims yesterday amongst the lowest of the year, showing that there is this kind of low firing environment. But the reason it is important is because it ties into what's been happening in terms of the fading out of cuts from the Fed because of the energy shock, and whether or not the jobs number, what is the job print that changes that and brings cuts back onto the table? There's still about 40 basis points priced in for the Fed, but what kind of non-farm payroll number brings those cuts back to the level that we saw prior to this conflict? So that is why the data is important, even as our focus remains, of course, on the geopolitics and the war in the Middle East. Here's what else you need to know this morning then. President Trump has removed Kristian Noem as Homeland Security Secretary after months of controversy. She's the first cabinet member dumped during his second term. Noem faced bipartisan rebukes during congressional hearings following a federal immigration crackdown in Minneapolis that saw agents kill 2 U.S. citizens. Trump says Oklahoma Senator Mark Wayne Mullin will take over by the end of March. Oracle is planning to cut thousands of jobs as it moves to handle a cash crunch from its massive AI data center expansion effort. We're told the job reductions may be implemented as soon as this month and will affect job categories that the company expects it will need less of due to AI. Bloomberg has learned that SoftBank, meanwhile, is seeking a loan of as much as $40 billion to help finance its investment in OpenAI. The potential size of the loan underscores SoftBank founder Masayoshi Son's aggressive bid to try and position his company as a linchpin in the global AI boom.
So some tech threads to keep an eye on this morning. Coming up on the programme, as the number of cancelled flights to the Middle East tops 27,000, we'll bring you the latest air travel update. And Lufthansa has been reporting numbers and talking about the Iran conflict this morning, so we'll bring you that conversation later. Plus, we will talk about Iran. Kasra Aarabi from United Against Nuclear Iran joins us in the next hour to talk about the next steps for Tehran as the US president weighs in on the nation's succession plans. Who is in charge of that conversation right now is a crucial part of that narrative. Up next, we check in on the market. Sam Linton-Brown will be with us from BNP Paribas as investors assess the week in markets following the start of the war in Iran. If you have any questions for our guests, then please do get in touch. IB plus BBTV Go, that is the function to use. Live from London and across the Middle East, this is Bloomberg.
Welcome back. Happy Friday. We are about 45 minutes from the start of the opening trade. European futures actually pointing higher by 0.8%. They closed lower by around 1.3% yesterday, but broadly on the front foot today. US futures also pointed to gains. S&P E-minis up 0.1%. We have seen that divergence since the war, of course, in Iran between Europe and the US. Europe faring worse. But today, European futures pointing up by 0.8%. Lizzy.
We have seen Chinese stocks higher as well, Tom, as has been the case across Asia broadly. We are watching live pictures currently of the NPC continuing in Beijing. China's top legislators convening for this annual conference. Currently, they appear to be discussing foreign policy. They're deeply concerned, they say, about the Middle East situation as this NPC continues on air.
So we're watching what's happening in China. We are, of course, watching developments in the Gulf. A barrage of Iranian missiles and drones has targeted at least 5 countries across the Middle East, prompting several governments to urge their citizens to take shelter. This as Israel carried out a 12th wave of airstrikes on Tehran in a war that Iran says has already killed more than 1,200 people. The Iranian Foreign Minister Abbas Araghchi told NBC News that his country has not asked for a ceasefire and had no intention of negotiating.
And we are prepared for any other eventuality, even, a ground invasion. So our soldiers are prepared for any scenario. When I said that we are waiting for them, it didn't mean that we are waiting for continuation of the war. No, but we have prepared ourselves to confront with any scenario, with any eventuality, any possibility, and we know that we can handle that.
Bloomberg's Jumana Basechi joins us now from Dubai. Jumana, it's Friday. This has been going on for 7 days now. Bring us up to speed. What's the latest?
That's right, Anna. It is day 7 of the war with no signs really of things letting up. In fact, if anything, the operations have intensified. Joint U.S.-Israeli operations have continued in the last 24 hours. The Defense Secretary Pete Hegseth saying firepower over Iran is about to surge dramatically. And the Central Command also saying that they've struck around 200 targets within and around Iran in the last 72 hours. The IDF saying as well that they're moving into the next phase of the war. So overnight, more reports of strikes, missile strikes in and around central Tehran. And also the other front that was launched, we are hearing of aerial bombardment of southern Beirut, the southern suburbs of Beirut. And this is the front that opened up between Israel and Hezbollah, because Hezbollah shot over a series of missiles into northern Israel on Monday morning. In retaliation, IDF have now redeployed troops into the southern part of the country, have warned hundreds of thousands of residents to evacuate the southern part of the country, in addition to those suburbs, specifically in Beirut, which has led to mass displacement throughout the country. Hundreds of thousands of people are seeking refuge in Lebanon while this goes on. And then Iran themselves continue to be quite defiant. We are hearing that activity overnight in Israel has been quite subdued, but still projectiles being reported in and around Gulf states. Yesterday evening, a key refinery in Bahrain was hit, so they continue to target energy infrastructure. More drones intercepted over that Qatar Al Udeid base. And just a short while ago, I will tell you that we over here in Dubai have heard explosions, we've heard blasts. Yesterday evening, we received alerts of an incoming missile strike. And just in the last 15 minutes, anyone at Abu Dhabi airport was advised to take shelter. So the Gulf region still continues to receive the lion's share of the Iranian retaliation.
OK, Bloomberg's Jumana Basechi on the ground for us in Dubai with that important update. Jumana, thank you. Meanwhile, sharp swings across asset classes have unsettled traders, of course, struggling to price risk as headlines from the US-Israeli offensive against Iran ricochet through the markets. Let's bring in, for further analysis, Sam Linton-Brown, Global Head of Macro Strategy at BNP Paribas Markets 360. Sam, good morning. You were telling us during the break that on Saturday you had a call. Over the weekend you had a call with clients and you said buy the dollar. Is the dollar looking capped at this point? Does that continue to be the cleanest way to pay the geopolitics and the war in the Middle East?
We think it can continue. It's all about the duration of the war and if it means the Strait of Hormuz remains closed. If it does, oil and gas prices every day should continue to go up, and that's very supportive for the dollar. When you have these types of energy supply shocks, it supports the dollar through terms of trade. It supports the dollar through relative growth differentials. You mentioned in your opening remarks, European stocks have been underperforming the US. That's got a strong macroeconomic basis. And it can also support the dollar at the margin through the relative central bank reaction functions.
How are you playing? Is it via euro-dollar? What's your favourite cross to play the dollar strength story?
We like euro-dollar lower in the near term. That should go down. I think from a trading perspective, the better asymmetry is in the dollar versus some of the even higher beta euro plays, like the Swedish krona, where positioning was rather long heading into this event. And there's an even greater sensitivity to the energy side than in the Eurozone. We also think dollar-yen, somewhat controversially, can actually go up in this environment. And we also counter to consensus dollar-China higher.
Good morning to you, Sam. Let me ask you about what you're watching in the rates environment, because we've watched rates to different degrees around the world, but rates going higher, and treasuries have not been immune. We've seen resilience in US stocks, perhaps, to everything that's developing, but we have seen movement in treasuries. How is that comparing across the Atlantic, compared to Asia? Where are you expecting the treasury move in yields to be higher most substantially? And is that all inflation, or are there other things at play?
G4 duration has absolutely not proven itself to be a safe haven in the latest escalation. And I think what's key here is the market's very focused on the near-term repricing higher we've seen in inflation expectations. And because, in the case of the US, the Fed are priced to cut rates, it's really questioning, can the Fed cut rates when the starting point for inflation is above target and you have an energy supply shock that pushes inflation even further above target? Our view on the US, even prior to this, was that the Fed wouldn't be cutting rates this year. The US economy, we think, is simply too strong. While inflation is contained, it's contained at above target levels. And so when you add on an additional layer there that you've got a higher assumption for oil and gas prices than you previously had before, we think it means that the Fed will not be cutting rates. We like to pay the front end in the US.
OK, so not cutting rates. So is that all year? And what role then for things like the labour market report that we're going to get, non-farm payrolls later today? Can it cut through all of the other inputs into markets this week?
Fed view, it's no rate cuts for the whole year. So that is all year. In terms of the payroll report, it's important. It's absolutely important. If we're in a scenario where, contrary to market expectations, we start to see the unemployment rate go up, then the market may believe, look, the Fed's going to cut rates anyway because this is labour market weakness. That's not our view. We agree with market consensus. In fact, we're a little bit above market consensus that the pace of hiring will be solid, above the level that's required to keep the unemployment rate stable, so above break-even hiring levels. And for this report itself, we think you probably will have a stable unemployment rate. So that's data we see consistent with the Fed remaining on hold.
The opposite to the Stephen Myron view expressed on Bloomberg TV. Sam, coming back to the war in the Middle East, some of our guests have said that the 2022 playbook after Russia invaded Ukraine, of course, is the one to use now. Others say that they're barely comparable. What's your view?
I think it's a bit of both. I wouldn't say it's the right playbook because the likelihood in this case of oil and gas prices going very high for a really economically meaningful amount of time, I think is much lower than in the case of Russia-Ukraine, because there's such a mismatch in military might from the US, Israel, etc. versus Iran. So I think it's reasonable to assume that at some point in the next few months, the Straits of Hormuz reopen. And that will be an important moment for the market that implies even though we could see oil prices going above 100, if they do, they're not going to stay there on a more structural basis, contrasting with the types of move we saw in oil and gas with Russia-Ukraine. I think the question is, what's the market pricing today? And I think it's pricing in a relatively quick resolution. So, I mean, even, for example, today we see a bit of consolidation in the market. If we come in on Monday and there hasn't been a de-escalation, I think it will be risk off, because the market's really of the mindset that this could de-escalate at any moment. And that assumption, we believe, seems quite complacent. So we're cautious, at least in the FX and rate space, credit and equities perhaps somewhat different, to be adding risk here. Eventually, there will be a buying opportunity, but we think it's not here.
And you say that gas is more important for Europe than oil. Do you have a calculation of kind of how much a 10% rise in prices for oil and gas feeds into inflation?
Inflation in Europe is actually not, we'd argue, really a problem at this level. So 1 year inflation break-evens in the Eurozone have repriced higher in the past 7 days to target. So it's quite a contrast with the US. Inflation's only now priced to target in the Eurozone, whereas the US is the area we'd actually be a little bit more concerned.
It's interesting because that's what Nagel of the ECB said to me yesterday, that it's more, he actually is more concerned about inflation than growth, so the opposite to you. But so then, how much did the 10% increase weigh on growth in the Eurozone?
Yeah, it's all about duration and about expectations of consumers if the increase is going to be temporary or it's going to be permanent. So given that people's expectations here, we think, is that any rise in energy prices will tend to be relatively short-lived. The growth impacts shouldn't be too significant, provided we avoid that worst-case scenario of oil going above 100. So the broader story, I'd say, for the economy is, if you avoid oil going above 100 for, say, 6 months, we're still in a resilient growth backdrop. Europe is more negatively affected than the US, but globally speaking, we're still in a resilient growth backdrop. So to draw the contrast to Russia-Ukraine, where we clearly went to much higher levels for a much longer duration, I think the downside macro risks from what's happening here are less than that. That said, because the market really seems convinced we're going to have a quick de-escalation, we'd say it's too soon to buy risk. Yeah,
and you're saying that's the consensus view which you push back on, and we'll see how that evolves, of course, over the weekend. Sam, thank you very much indeed, taking stock of what has, of course, been a significant week geopolitically and for the markets as they adjust, of course, to the realities on the ground in the Middle East. Sam Linton-Brown, Global Head of Macro Strategy, Head at BNP Paribas Markets 360. Coming up, we're going to talk to Sonia Martin, Chief Economist at DZ Bank, as the dollar heads towards its best week in more than a year. We'll get views, again, further insights in terms of the inflation outlook, the growth outlook, and how to think about FX hedges in this environment. Stay with us. This is Bloomberg.
Welcome back. 30 minutes from the start of Friday's cash session here in Europe. Let's look at the European futures picture then on Friday the 6th of March. And it looks pretty positive. Euro Stoxx 50 futures pointing 0.9% higher. Some of the best gains perhaps to come in the markets that were more sold off, like Germany. But we are expecting to go broadly higher. Yesterday we saw weakness across the European equity markets. We saw weakness in the States as well. But there was a little bit of a sense of recovery towards the end of the US day maybe. And so we have a bit of that to price in. US futures are also pointing a little higher, but not quite as high as Europe. 0.3% higher.
A bit of stability in the bond markets after they sold off. Of course, they have not played that hedging role in terms of safe haven roles this week. Energy costs, of course, and pricing in potentially more hawkish central banks. But today there is a little bit more stability. You're seeing yields down in Italy. You're seeing yields down over in France as well, about 2 basis points on the 5-year there as well. 283 on the German 10-year. French OATs at 345. Largely stability in the Eurozone debt space, bond space, sovereign bond space, at least for now.
In your currency space, you have euro dollar flat to the upside. 116 is where we trade today. The Bloomberg dollar spot index just weaker a touch, but the dollar heading for its best week in more than a year after the US strike on Iran triggered a flight to safety. Traders will now turn to today's jobs report to see whether the rally will continue. And this is what our guests have been telling us this week about the market reaction.
Markets aren't going to price the tail risk until they really see it happening. And here, I think it's probably a less severe sell-off than we saw in things like the tariff.
It's all about the duration, and through the duration, the impact on particularly the energy market, maybe also some transportation hubs and all of that. So as long as the region is reeling, as you were saying, this is a problem for markets.
What's less clear is whether we have pure inflation or whether we also get a demand shock as well. So then you have this stagflationary outcome.
The 22 shock was an energy shock, and it really built up that big inflation surprise, if you will, and we saw massive hiking. But it's early days still.
At the moment, the market is not panicking. We are seeing a justifiable increase in the risk premium and in oil prices, but there is no serious deficit to start with.
The environment is different. The munitions are different. The capability of hitting more tankers, more ships.
Going back to 2022, it became very clear that the issue around energy independence, diversification, affordability and competitiveness, all those issues are very conducive to actually investing more in renewables, where you actually can take advantage of your natural resources without having to import fossil fuels from outside.
So the market not panicking. For more, Sonia Martin, chief economist at DZ Bank, joins us now. Good morning, Sonia. You've written that traders, it seems, are waiting for taco, for President Trump to chicken out, for the Trump put when it comes to the Middle East war. What's the pain threshold for the president in the markets?
Well, I mean, I think the problem is that, when you look at the market reaction, it doesn't really seem to fit the story. I mean, we would look at what's happened this week. I think many of you guests have just pointed this out as well. The market reaction has been somewhat, fairly moderate and a bit confused. And I think that's because people are not pricing in the scenario where this war is prolonged and lasts, more than a few weeks. And so I think that's the pain threshold. I think people are assuming that with pressure on Trump domestically, the war is not popular in the US, higher energy prices resulting in higher gasoline prices isn't something the US administration will want to see before the midterm elections. And of course, falling equity markets isn't something that Trump likes to see. Equally, he doesn't like rising interest rates on US Treasury. So all of that is assumed to build pressure on the US president, and he will declare the war over and successful at some time in the next couple of weeks. And I think that's the assumption. If that doesn't pan out, obviously that's going to be the point where the market will have to reassess its current stance.
But are you expecting the oil price to keep on climbing? We've seen Goldman analysts saying that Brent could cross $100 a barrel if the Strait of Hormuz experiences several uninterrupted weeks of several weeks of interrupted oil flows. Where are you modelling for oil to get to?
Well, I think like everyone else, we're modeling in different paths right now. We have to think in risk scenarios. I mean, there's certainly still a de-escalation scenario where we go back to, the oil price where it was before that this happened. And I think that is still entirely possible. But of course, yes, if you're thinking in more risky scenarios than an oil price above 100, I think we're modeling 110 in a worst case scenario is absolutely possible because it is 20% of supply that will be missing. Some of this can be replaced, but not all of it. I mean, the pipelines can only hold so much. much. There's some overcapacity in countries where that can sort of, pick up production, but we can't just sort of pull a switch on Venezuela or fracking in the US and say suddenly we're producing so much more. That's going to take time and investment. So if that does happen, if the Strait of Hormuz is closed for a prolonged period of time, permanently, worst case scenario, yes, we will have an oil price that is above $100.
Sonia, we're working through different scenarios. In one scenario, there is a resolution in fairly quick order, to your point. If we land on that scenario, how quickly do these moves that we've seen, whether it's in the euro or dollar or energy and oil prices, how quickly do they snap back to pre-war levels?
Well, I think fairly quickly, to be honest. I think we have seen in the past that the market is quite willing to sort of to play the positive card, if you will. I think if this war ends, if the US does pull out and declare the war as having been won, and if the region, and this is, I think, at this point, the crucial question, if the region calms down as well as a result of this, I think we'll be back to pre-war territory fairly quickly. I think investors are willing to go along with that, and I think we'll be back in a much more positive market environment if that does happen.
BNP Paribas, Sam Linton-Brown telling us he doesn't think the Fed moves this year. No additional cuts from the Fed. Does that align with your view? And what are you looking for from the jobs data today?
Well, I mean, obviously, in the current environment, it's very difficult for the Fed to decide what they're going to do. There's, the fact that we're going to have higher energy prices. And I mean, even if the situation is resolved fairly quickly, obviously there will be some impact on inflation. I think central banks can obviously look through this, but it might still make decision-making a little more difficult. At the same time, we have, of course, a president who wants the Fed to lower rates and is going to push for that quite aggressively. If we have a resolution fairly quickly, I think the Fed can continue to cut rates as planned. The timing might shift a little bit. In a scenario where, of course, longer-term price effects are going to be seen because of the oil price, etc., that will put the Fed under considerable strain, and they might have to reconsider their Fed rate cuts this year.
Sonia, good morning. We've been thinking about the currencies that you might have expected to gain this week that haven't. And I'm thinking about the Swiss franc here in a European context. It hasn't gained. Is that because the market feels that the central bank will not allow it to? There'll be some kind of intervention. There could be negative rates, even though that's been previously ruled out. I mean, what is it that's putting people off? Or is it just that the dollar strength is so overwhelming?
To be honest, all of the above, I think. It absolutely is a mixture of all of those factors. I mean, for one, yes. I mean, market moves in safe havens have been much more moderate than we might have expected to. I mean, look at where the gold price is, right? So that's one point. The dollar strength is a point in general. But I think, yes, the SNB has made it very clear that it does not want to tolerate a stronger currency. Now, it's in an exceedingly difficult position here. I mean, lowering rates into negative territory is not something you really want to do because that has a negative impact on the domestic financial sector. Intervention in the market against maybe possibly a strong trend is difficult and also is undoubtedly going to very much anger President Trump. So it's a very difficult situation. But I think all of these factors have contributed to the moderate move that we've seen.
Yeah, and the yen often cited as a haven as well. I mean, the domestic story around the yen was complicated enough without this additional news flow, Sonia. But now you add in Japan is an oil importing nation, and things get tougher from that perspective. Yeah. Is that why we've seen the yen held back, or is it still domestic?
Well, I mean, I think the comments this morning from the finance minister didn't exactly help. I mean, the word deflation in this environment was kind of a bit odd of a mention. Dollar yen already moving higher. And then you mentioned deflationary, the fact that Japan could go back to deflation. Maybe the comments were taken out of context a little bit as well. But that obviously has contributed to the yen weakening further. There's a complicated domestic story. I mean, the yen as a safe haven has always been a bit of a controversial topic, I think. And I think in the current environment, with everything that's happening in Japan, is going to be a difficult sell. However, as you said, Japan does import all of its oil. So if we get a lastingly higher oil price, that is definitely going to push inflation in Japan. And that could change the story for the yen as well.
Sonia, hope you have a restful weekend. That's Sonia Martin, Chief Economist at ZZ Bank. Thank you so much. Well, as we say, traders and central banks are eyeing the potential inflationary impact from the Middle East war.
It is often like that the duration of the war is the main driver of the inflation outlook, at least on the medium term. So It is, as I said, we see a lot on the energy price front, and now it's the question, how is that maybe spilling over to the rest of the economy?
The Bundesbank President Joachim Nagel there. More on the potential economic spillover from the US-Iran conflict next. This is Bloomberg. 16 minutes away from the opening trade, and here's the futures picture, looking more optimistic here in Europe than on Wall Street, but both recovering after what has been a volatile week. All eyes, of course, Anna, on the Middle East.
Yeah, absolutely. And for those operating shipping businesses, they are closely watching the Middle East. Maersk has announced this morning it's suspending 2 of its routes. One of them runs from the Far East to the Middle East, and the other runs from the Middle East to Europe. The first of those, which they've announced this morning, FM1, is going to be suspended. That was previously calling at Jebel Ali in the UAE, so obviously it makes sense that that one is not going to be operating anymore. The other one is ME11, which runs from Europe to the Middle East and vice versa. And this is the one that had already been disrupted by the Suez Canal being closed, and so Maersk was already diverting that one south around the Cape of Good Hope, around the south of Africa. And that was previously, on some occasions, calling in Oman. So it makes sense, I suppose, for that one also to be suspended. And it just speaks to the level of disruption, really, that we're seeing in the region.
That Maersk is having to take these steps. They continue to see the impacts at a time when the Straits of Hormuz, we know, is effectively closed away. So the supply chain constraints, a reminder of that today with the actions of Maersk. And that's a stock that we'll be watching, of course, as well. And we will have to wonder, China, there are reports that China's putting pressure on Iran to continue to keep the Straits of Hormuz open. We know the US is discussing what they can do to try and open up that waterway. But so far, there's very little traffic.
They're giving us some thoughts and some reasoning as to why they're doing this as well. It's based on their latest risk assessment, which will be no surprise to anybody, but also an operational review considering escalating conflict affecting safe navigation in the Gulf region. It's been a precautionary measure to ensure the safety of personnel and vessels. And it goes back to, conversations we were having earlier on this week, that this isn't just about insurance. Just because you can get insurance doesn't mean that ship owners, let alone ship captains, are going to take those ships through the straits.
Yeah, ING pointing out that even if you had Navy escorts for these ships, they would be sitting ducks, in their words, a target perhaps for Iran.
Meanwhile, the US has cleared the way for India to temporarily increase its purchases of Russian oil. Washington issuing a license which covers transactions related to Russian crude and petroleum products loaded onto vessels before March the 5th. We're now joined by Stephen Sochinsky, who leads our Asia energy coverage. Stephen, why is Trump reversing course now then? He's been putting pressure on India, obviously, for months in terms of their purchases of Russian oil. How significant is this change in dynamic? What does it do to the markets more broadly?
So I think there are 2 ways to look at it. One, this is great news for India, right? This is a geopolitical win for them. You know, we've been talking to refiners, companies, manufacturers, importers of energy from the Middle East. And India was among the hardest hit countries, so this is a big benefit for them. It is temporary, just 1 month of a waiver, and it's just the oil that's on the water. Now, when you look at the broader situation, this is more of a bandage on top of what's happening in the oil market. This is broadly not really going to change how prices react. You might see maybe prices fall a little bit because of it. We saw that happen early in the day. But overall, as long as the Strait of Hormuz remains shut, that is still a lot of oil that's not making its way into the market. 20% of seaborne supply not making its way to buyers, mostly in Asia. So really, this appears to be a move by the Trump administration to help out India, but they did make it very clear this is just a temporary 1 month sort of thing, one and done. This is not a policy shift on Russian oil or gas.
OK, temporary, as you say. Stephen, thank you very much. Stephen Sochinsky, who leads our Asia energy coverage. We'll watch those developments. We'll also watch any other policy announcements around oil coming from the Trump administration. There has certainly been talk of other things being considered. Let's get a broader take on the markets as we bring this week almost to a close, Friday the 6th of March. Our Markets Live executive editor, Mark Cudmore, is with us this morning. Mark, we have had this movement on oil, this temporary allowance for India to buy Russian oil that's already floating in the sea. It has maybe taken the edge off the oil price move a little bit, but doesn't feel as if it really moves the dial a huge amount. What are you seeing when it comes to energy markets?
Well, you can see that oil markets at the moment are trading at their highs of the week and substantially above kind of where they've traded over the past year. And so I think that's going to ripple through markets. So I've got an echo of myself in my ear here, which makes it pretty hard to talk. But ultimately, I think the energy price impact is going to be very, very problematic for markets. And it doesn't look like it's going away. The Strait is not opening. And in fact, more and more shipping lines are restricting supply. More and more production in the region is shutting down. And therefore, the impact globally will continue to build.
Well, Mark, we love the sound of your voice, even if it's difficult for you. Look, you were right about gold. We're seeing gold set for a weekly loss, the first in more than a month. And your team has been right, it seems, when it comes to the dollar, the safest hedge against the geopolitical risk. Can the dollar's gains continue?
I think the dollar continues to outperform for as long as the conflict lasts. And similarly, I think the gold has more downside as long as the conflict lasts. That's because the geopolitical risk trade has played. For gold to get another geopolitical bump from here, you need to see the war escalate substantially. What would that entail, given that it's already a multi-nation war fully involving the US? Perhaps a more extreme form of weapon, I don't know, but I don't really want to postulate about what that could be. But for that, gold is likely to decline. Dollar is higher, yields are higher, and the geopolitical risk trade is played out. And yes, the dollar will continue to gain for as long as the conflict runs. And I still hate hearing my voice, Lizzy.
OK, we really hope the technical team are working on this, Mark. To Lizzy's point, the dulcet tones of Mark Cudmore at the end of the week, there's little that kind of tops that, Mark. On the Treasury markets, where is there, in terms of the way the Treasuries has adjusted through this week, how does that inform your views? I mean, there's so much debate. This is going to be a dovish Fed governor, and yet we could be looking at sustained inflation, or at least sustained inflation above that 2% target. We're still above that for the Fed, and yet we're going to have a dovish governor. How does that dynamic play out, and is that reflected, do you think, fairly in Treasuries at this point?
It's probably OK for the moment. I think we have to remember that the US itself has tools it can take to control the energy shock. Not only is it a major energy producer and therefore less exposed to this directly, but it can release oil from the SPDR reserves, and therefore, that can limit some of the oil price gains. I think it'll experience some of the global inflation shock here, but less extreme than other nations will experience. So I think treasuries are fine for the moment.
Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up-to-date analysis, Mark, thank you, and insights from Mark and the rest of the team. Just go to MLive Go on your terminal. Let's bring you Chloe Maynard right now with a view on the stocks to watch this Friday. Chloe, what are you watching?
Good morning, Tom. Energy is still very much in focus, top of mind, as it has been throughout this entire week. We have, of course, seen oil prices spiking, which has in turn really boosted the share prices of all of those names up here on the board. But now we have got the Trump administration considering a variety of options to try and tame those oil prices, with the Interior Secretary saying that the US could take on potentially more risk to try and re-establish a sense of normalcy within that global energy market. So we'll be watching out for the impact there. We have seen a slight pullback in Brent as a result. So we'll see how those oil companies behave at the open. Moving on to Lufthansa, which has very much been on the other end of those oil prices spiking, with airlines seeing quite a lot of share price weakness because of those higher fuel prices. But today, Lufthansa could actually reverse some of the weakness that we have seen recently, because it expects a significant earnings improvement in 2026. It says that, of course, the events in the Middle East create a lot of uncertainty, but that there's also an opportunity there with growing demand for some long-haul flights to and from Asia and Africa. So definitely a big story to watch out for today. And finally, Roche and Zealand Pharma might be weaker after their experimental obesity shot failed to impress investors. So the weight loss was comparable to a placebo, and so it fails to clear the bar that was set by analysts. We've seen those two companies go on very different paths, as we can see in terms of share price performance, but they could both be in the red this morning on the back of that disappointing trial data.
Chloe, thank you very much. Chloe Melly with Stocks in Focus. We could add a few more to the list. Before we do, just a reminder that yesterday was quite a negative day for European stocks. We had only one sector in positive territory. That was media by the end of the day. But everything else was in negative. And we are looking for something of a clawback for some of that today. Yeah, Chloe mentioned Lufthansa and perhaps the idea that carriers that are not based in the Middle East, like Emirates, could be benefiting from this war, because you could connect Africa, Asia and Europe with long-haul flights. But then also IAG shares could be one to watch today. We had the Heathrow Airport chief CEO saying that the war is posing an operational challenge to the London hub, and so in particular BA could be hurt by this. Yeah, lots of aircraft parked up. I think
27,000. Is it 27,000 flights now? And you're getting individual countries trying to evacuate their personnel and their people and their citizens out of the Middle East, of course. And the UK is playing the role. We've heard from Japan talking about trying to do that as well. In the chip space, we were talking at the top of the show about what's happening with Nvidia and AMD, and they took a bit of a move lower in the session yesterday on the Bloomberg, reporting that the US may be planning these additional restrictions on shipments to other countries. There's competing stories around the chip space. The companies like ASML, you've had days where they've performed relatively well so far this week. Broadcom came out with a view on $100 billion of revenue. You've got Marvel coming out with a pretty positive outlook as well. So we'll see how that ties into the chip-making space and the hardware space in Europe as well. Also worth pointing out, as Mark was doing, that we're at 85.50 on oil. We're now in positive territory on oil. So as we move towards the European Open, that can put some upside pressure on oil stocks, and it might pair gains for some of the other consumer-facing businesses, if that's the direction of travel, even despite the news that we've had out of India. More broadly then, we'll keep an eye on the commodities and what that does to basic resources. That was an area of underperformance in yesterday's session. We'll be back with the market open. Futures are pointing upwards this Friday. US futures also pointing higher, but not by quite so much, up by 1.2% for US futures this morning. This is Bloomberg. Welcome back. A few minutes ago until the start of the last cash equities trading day of the week here in Europe. So let's have a look at the handover from the US session. A slightly calmer feel to the markets, at least, as we head towards the end of the week. This is yesterday's session. When Europe closed out, the US markets were in a bit of a downtrend, but then things turned around a little bit. They had some negativity, but then pulled back upwards towards the end of the US session. So it does seem as if that positivity is something that we need to factor into our European markets, and futures, Tom has more on that in a moment, are pointing higher. We've got also the non-farm payrolls number out later on today, and on a normal non-farm payrolls day we'd be saying that markets are likely to just tread water, sit on their hands until we get some clarity around the jobs picture and Fed impact. But today's a little different, still watching for the headline risk coming out of the Middle East, Tom. Yeah, it has been a choppy week for European stocks. It's been a headline-driven week for European stocks. You saw the losses of 1.3% across the benchmark yesterday. You saw a bit of strength coming through for tech, for media, and the weakness came through in terms of the industrials and in terms of travel and leisure. Today it's a very different picture. Once again, futures pointing high by 0.8%. Certainly weak dollar is going to be a positive catalyst. FTSE 100 futures pointing to gains of 44 points. DAX futures looking to add 159 points, pointing higher by 0.7%. Lizzy, what are you looking at? Well, as we have all week, Tom, I'm watching the airline stocks, but in particular Lufthansa. They were out with earnings this morning, seeing a significant improvement in 2026 and looking to add long-haul flights because of the Middle East war. Also watching IAG, though, as the CEO of Heathrow Airports talked about the operational challenge from the war impacting BA. Hundreds of flights cancelled, aircraft sitting idle on the tarmac. Again, we watch energy stocks, oil up this morning, and we watch chips here in Europe after Marvell gave an estimate-beating revenue forecast, confirming strong AI demand. Anna, we're getting towards the open. Yeah, we absolutely are. Let's have a look at where we are on the European market open then for this Friday morning, with payrolls still ahead of us. Plenty of headlines, no doubt, coming to us from Iran and about Iran. We'll certainly keep an eye on that. Here in Europe, we focus on the energy prices, and we have seen a drift higher in oil prices this morning, despite those news lines around India and what the United States will allow India to buy in terms of Russian oil. So the FTSE 100 out of the gates up by 0.3%. We have a fairly heavy weighting towards energy
markets, so maybe that's part of the narrative there. But we had broadly been expecting then some positivity at the start of trade, catching up a little with the US of yesterday. So the CAC 40 up by 0.5%, the IBEX over in Spain up by 0.5%. So broadly speaking, we seem to be starting at least the last session of the week on the front foot, Tom, with positivity in mind. But of course, we remember just yesterday we saw the markets whipsawed in terms of their risk appetite by headlines around Iran.
Yeah, and travel and leisure is certainly a sector that gets hit by those headlines. So you have to wonder to what extent the gains that we're seeing in the session today will be sustained as we continue to monitor developments, of course. Travel and leisure, so far, the top performing sector, having been one of the worst hit yesterday. That sector is currently up 1%. Banks also getting a bit of a lift, up 0.7%. Basic resources having faced some pressure yesterday, turning around in the session today. But again, it's travel, leisure, financial services, banks at the top of the list in terms of sectors. Just one sector in negative territory so far, which is food and beverage. We have to think about food prices as well. Fertiliser prices expected to tick up as well, what that could mean for food. But currently that sector is down 0.2%. Every other sector in positive territory, travel and leisure at the top, Lizzy.
Well, checking in on some of those stocks we had flagged, Lufthansa shares are actually up more than 2% this morning. And IAG, despite the warning, is up 1.4%, despite the operational challenges at Heathrow flagged by the CEO. We talked about energy, and it's a mixed picture there, actually. Even though we've had Brent higher this morning, the Brent price has been fluctuating, and indeed we're seeing Shell flat to the upside, BP flat to the downside, and Total in just negative territory too. I'd flagged the chip stocks. It's a mixed picture there as well. BE Semiconductors down 3.2%, ASML down 0.1%, Infineon down 1.6%. We were factoring in those Marvell forecasts, which were positive, but it seems a pretty negative picture for European chips this morning. We'd also seen those losses in the US session for Nvidia and AMD. Perhaps that policy uncertainty around President Trump's chip policy is weighing in here a little.
OK, let's talk about these markets in more detail, widen out our conversation. Let's bring in Karen Georges, who's a portfolio manager at EcoFi and joins us now. Karen, nice to have you on the programme. Thank you for joining us. So we're 7 days into the war in Iran, and clearly this is something that is at the front of mind for everybody in the markets and trying to work out what happens here, a lot of headline risk. As we come to the end of this week, how would you assess risk appetite in these markets?
Well, the war in Iran, it kind of broke two big shifts that we've had since the beginning of the year. First of all, the narrative of AI at risk. So it's very interesting to see that when there was this market meltdown since the beginning of the week, the stocks that represent, this whole AI at risk theme have been up. So they were down more than 20% year to date. Now they're down maybe minus 12 or 13%. So it kind of put that narrative on hold. And the second narrative it put on hold is the big rotation, because until the end of January, more than 1 trillion stocks have been rotated in the US. That's huge. That's a record. So that kind of narrative has been put on hold. So tech is back. It's seen as defensive, relatively not concerned by the war in Iran. So that's the first thing that we can maybe think about. The second aspect is the length and duration of this crisis. That's the whole question, because as you said, oil has been up almost $100, but gas prices in Europe that doubled in 2 days are now only up 50%. So it's kind of a bit quieter on that front. The whole question is the duration of the crisis, and of course what it means on inflation if it lasts long. If it's short-lived, the impact on inflation should be manageable for Europe. So that's the first aspect of this crisis.
Yeah. And how inflationary, it's difficult to know, given we don't know how long it lasts for, Karen, but what assumptions are you making about how inflationary this becomes for Europe?
It's very complex, because a lot of people are doing like a parallel with the Ukraine war. The situation now is very different, because at that time you had a supply shock and a demand shock. Today, it's only a supply shock if it lasts longer, so there is no demand shock. And the budgets of European states are maybe less comfortable to give energy checks if it lasts longer. So the switching is a bit different. However, if there is an inflation shock that lasts longer, it will have an impact on demand. And so that is not inflationary. So it's very complex. So maybe it could lead it to still a statu quo from the ECB. The whole question is, what is the impact on demand? So Obviously, if it lasts several months above $100, it would be a bad reason to increase rates, because up until now, markets may be priced in a good reason to increase rates, which is a higher activity in the Eurozone. So that might be an issue for the ECB, but it's too soon to tell. I think De Guido's spoke this morning or yesterday saying that they are looking at the situation, but up until now, they're still in a good position because inflation is still close to 2%. So it's still comfortable for Madame Lagarde to keep interest rates unchanged.
Karen, good morning. It's Tom here in the studio as well. You're talking about upended narratives as a result of this war in the Middle East. One of those, of course, is weak dollar, and dollar has been a clear beneficiary of moves as a result of haven positioning. So my question is, to what extent the relatively weaker euro, can buffer European corporates? To what extent that will be a buffer for European equities and European companies going forward?
Well, we've seen there's been a clear disconnect between the euro dollar and European performance compared to previous years, because the dynamic for Europe has been largely domestic, so less sensitive to FX, and maybe unfortunately less sensitive to China also, because after 2 or 3 bad years, the European markets have been more focused on their domestic markets. So going forward, maybe there's less sensitivity. Even if the euro goes down, that's not going to boost particularly results of exporters in the Eurozone. So FX probably won't be a big issue for Eurozone companies, maybe a bit more for Nordic or for Swiss companies that have really seen a very strong currency compared to the rest of the world. But for Eurozone, it won't probably move the needle much. And also the second argument is that since activity is quite resilient, and if there is a little spike in inflation, it will be both in the US and the Eurozone. So you won't have that disparity between the two areas. So that won't justify a big increase or decrease in the euro.
Karen, if the war does come to a relatively quick conclusion, does European equity outperformance versus US return, and how quickly?
I think it would be very fast because, as you've seen before, the start of the war, Eurozone was really outperforming the US, and so now they're almost equal. So they should be back into this narrative of outperformance, and that also has been partially on hold because Japan is still outperforming the US and Europe. So if the war comes to an end quickly, we should be back to this narrative of the rest of the world against the US. So we still think that if valuations are around 16 PE for the Eurozone, it's still a very hard, strong argument for outperformance and decrease in gap between the US and the Eurozone. And just to point out for the last results for EPS, the gap between increase in EPS for the US and Eurozone has narrowed. It was 14% for the US, plus 4% for Europe, up until the end of February, of course. So that also is justification for outperformance for the rest of the world against the US.
Karen, are UK equities a good place to hide out during this war? Or at some point, if oil keeps climbing and BOE rate cuts keep being priced out, is that no longer a good idea?
Well, the UK index is very particular because you have a big part of commodities, banks, and consumer stocks. So obviously the consumer part would be hit. And even before the crisis in Iran, the biggest warnings that we've had of big names on the stock market in the US and a bit less in Europe is consumer names, big consumer companies, Mondelez, McCormick, etc. So in the US, to give some examples. So that might be an issue also for consumer companies. Commodities should be a bit more immune, obviously, as for energy stocks. So the UK is still cheap. It's a cheap market even to the Eurozone. But it's a very complicated market. Also, there's another thing about the UK. It's a very good candidate for M&A. So that also could be a support for the index going forward if you have more operations on M&A.
And Karen, I'm looking at defence stocks up today, but are you surprised that European defence stocks aren't up more because of this conflict?
Well, there's been a bit of a profit taking, I think, on defense stocks. That's the first thing. And the second thing that is a bit more maybe cynical is that a higher oil price is good for Russia. So it's good for pursuit of that war. And maybe that's also a reason why defense stocks have been down. Also, maybe issues on volumes that have been flagged for defense stocks in the US. And so also there's a form of contagion, a correlation. So that's why there has been a volatility in defense stocks in Europe. And that's why maybe they were down yesterday, probably.
Karen, great to see you. Thank you so much for your insights this morning. That's Karen Josh, Portfolio Manager at EcoFi. Thank you very much. Well, let's check in on the core six this morning. We were just discussing Rheinmetall. Those shares are higher by 2.75% this morning, as we are seeing gains for many of the names across the defence sector. We're also looking at LVMH actually up 1.2%. The losers in terms of the core six this morning are ASML and Nestle. But let's get a check on some of the individual stocks that we're in particular watching today with Chloe Melly. Chloe.
Good morning, Lizzy. Zealand Pharma is taking a massive hit this morning, down almost 30%, and Hosh is also taking a bit of a hit after their experimental obesity shot failed to impress investors. So the weight loss was comparable to a placebo, and so it failed to clear the bar that was set by analysts, and it means that their product will not yet be able to compete with products from Novo Nordisk and Eli Lilly within that obesity space. So that is a big setback for those two companies, and we are seeing the shares down significantly this morning on the back of that. Moving on to Lufthansa, which is up this morning after saying that it expects significant earnings improvement in 2026. It said that there was still the challenge of all the uncertainty caused by the conflict in the Middle East, but that there's an opportunity there as well for those airlines that are not based in that region to expand capacity for long-haul flights connecting Europe, Asia and Africa. And so we are up more than 3% for Lufthansa this morning on the back of that upbeat outlook. Defense is also in the green. This is a theme that we've seen, of course, throughout the week, with this conflict showing really no sign of letting up. And therefore, we are seeing all of those names up this morning, in particular Hensoldt up almost 4% at the open. And finally, DHL, the logistics company, was upgraded to new ratings by both Barclays and Bank of America analysts. And so they said that that company will see some tailwinds from that conflict in the Middle East. They'll be able to capitalize on some of that supply chain uncertainty. And so because of those upgrades, we're up almost 3% for DHL.
Chloe, thank you very much indeed on some of the stocks on the move this Friday. Chloe Melly. Coming up, flight cancellations, meanwhile, to Middle Eastern hubs have surpassed 27,000 since the Iran war began. We're going to bring you the latest developments next. This is Bloomberg.
Welcome back. This is the opening trade, 16 minutes into Friday's session, and the European equity market picture is positive, catching up a little with some of the positivity on Wall Street yesterday, unwinding some of the losses of yesterday. So European stocks up by 0.3%, Tom. US futures pointing higher, but not by much. And we have non-farm payrolls later, of course.
And we have a reminder, of course, of the threat that continues to exist in and around the region as a result of the war in Iran, with Dubai residents getting a missile threat alert on their phones. And we've seen in the last 24 hours another barrage from Iran targeting regions, of course, and many of its neighbouring countries, including Abu Dhabi, where there's been alerts put in place around the airport there. Now, Dubai residents get a missile threat alert on their phones. We can see a live shot from our Dubai bureau there of the city as those alerts come through.
Well, the number of cancelled flights to Middle East hubs has surpassed 27,000 since the fighting began now. Meantime, Lufthansa says that while the conflict adds uncertainty to the outlook, the carrier is considering increasing capacity on Asian and African routes to meet surging demand. As you can see, the share's up 2.8% in the session so far. Well, let's bring in Bloomberg's managing editor for aviation, Benedict Kamel, who's in Berlin. Benny, are other carriers who are also not based in the Middle East likely to add more long-haul routes, as we're seeing from Lufthansa?
You'll probably see more of that happening. Lufthansa came out with their earnings this morning, and as part of that, they commented as in the Middle East in particular. It's a bit of a sort of a two-way street. On the one hand, they're saying this obviously injects a huge dose of uncertainty into the outlook. The costs will probably go up. Supplies through the Strait of Hormuz are more complex now. On the other hand, they see an opportunity here on some long-haul routes to Asia, to Africa, to other parts of the world, because obviously those services have now been disrupted by the companies that previously had a really dominant hand here, principally Emirates and Etihad and Qatar. So we heard from the CEO in a statement saying this is a reminder that the aviation world's Achilles heel is what he called it, and it's also a reminder, he said, that we should remain sovereign in Europe to direct our own traffic flows. So there's dare I say, a sense of politicization going on here, that the company sees an opportunity here, but it's also a thinly veiled reminder that this is a competitive environment and they see a chance to win some business.
Yeah, so expanding in certain areas then to take account of the fact that many of the Middle Eastern airlines that are based in the region, of course, are even more heavily affected. What's the assessment, Benny, of the extent of the impact on their businesses? I mean, do they operate any flights that don't go through their hubs?
So we heard this morning that Etihad is starting to resume some flights in the next 2 weeks. They put out a list of about 70 destinations. So that's a fairly aggressive sort of restart of operations. If you compare that to Emirates and Qatar, they are still on the ground, running only sort of rescue flights and exit flights for people who are trying to get out, but no real commercial operations. So Etihad is the first company that is resuming flights, but as you just said, we are still in a very, very difficult situation here in terms of the safety picture. We heard from that there are these alerts, that there are missile threats. So Etihad is doing this, with a backdrop of a very, very murky picture. So we'll have to see whether this is sort of on again, off again, start-stop kind of scenario. But they are trying to get to some degree of normalcy again, because we're talking about almost a week of totally suspended operations and about, approaching 30,000 flights at this point. So a huge financial hit on these companies.
Benny, when we do get a resolution to this conflict, how quickly can these airlines, not just in the Middle East, but globally, get back to pre-war levels in terms of capacity? And what are we seeing in terms of the jet fuel prices have shot up well above Brent and WTI? To what extent are these airlines hedged around that fact? Are we going to see higher prices, ticket prices as a result of this? What does the picture look like post-conflict?
I imagine that things will return to normal fairly quickly in terms of operations. These are mobile assets that they can move around fairly quickly. The big question is, how will demand come back? Will people feel less inclined to board an Emirates plane that goes via Dubai, given what they've seen in terms of the stranded passengers, given the insecurity of the airspace, and that might change people's minds about boarding these aircraft, and then maybe turning to the likes of Lufthansa, another route through maybe Helsinki on Finnair and so on, if they want to go to Asia on a long-haul route. So that's going to be a big uncertainty in terms of how the passenger flows change. The other is on the cost side, as you said, jet fuel will get more expensive, already is more expensive. How much of that can airlines roll on to passengers? How much are passengers willing to stomach some of this? We know in the US that US carriers do not hedge their jet fuel costs. So that's something that will immediately hit through to their bottom line. So some of the more vulnerable companies over there might have trouble passing this onto their passengers. So sort of in a good state, the big ones, United, Delta and so on, they can probably stomach the additional cost for a while. But those that are sort of already on the edge of what they can do financially, those are the ones that will really struggle. So you might see some fallout in the next couple of weeks in terms of profit warnings and so on. We already heard from Wizz 2 days ago, arguably a small carrier, but it gives you a sense of just sort of what a difficult situation we're in.
OK, Bloomberg's managing editor for aviation, Benedict Carmel, with that update. Benny, thank you. Meanwhile, Bloomberg has learned that the Trump administration is considering sweeping new controls over the global AI chip industry. Officials at the US Commerce Department have drafted regulations that would restrict AI chip shipments to anywhere in the world without American approval. Joining us now is Matt Bloxham, analyst at Bloomberg Intelligence. Walk us through the proposals then, Matt, and how significant they could be.
Yes, well, this is still very much in a drafting phase, but what we understand is that there could be different tiers of restrictions in place. So if you're looking to kind of export a relatively small number, say up to 1,000 Nvidia chips, then the kind of approval process might be pretty light touch. But if you're kind of looking for a large-scale deployment, say in the hundreds of thousands of chips, which would be kind of a fairly large data center, and that's owned by one company, then the local government might get involved, much more deeper scrutiny about who this company is, what they plan to do with it. So we'll have to see how this kind of plays out, but clearly some kind of clear signals there that the US government sees its strategic role in shaping the future of the global AI industry.
And Matt, we've had the news that Oracle's planning to cut thousands of jobs. Your team saying that this is likely tied to the CapEx decisions. How should we be interpreting it?
Yeah, so Oracle's expected to go heavily into the red on cash flow in the next few years as they build out their data center strategy. So I guess they're looking to some degree to balance these books, and also I think just reshape their workforce. This is if they're moving more into a kind of direct competitive cloud business, then perhaps the kind of headcount they've got needs to be rebalanced too. So Oracle's no stranger to restructuring efforts. This would be a much bigger one than they've done before. Our estimates are about $1.6 billion of cost. In the past, it's been a few $100 million. So I think to some degree, again, we've seen this before. To kind of reshape a headcount, you sometimes have to kind of shrink it first before you start rehiring. And so I don't think we want to kind of rush to make too many broad implications. But I think there is a degree here of repositioning, but also anticipating that some of the kind of things they do today, they'll be doing with AI, not people, in the future.
Is this quite a specific Oracle story then? Or does it tell us anything about the broader?
No,
AI
I think we've seen it in the recent past, and I think we'll continue to see it, that companies, whether they're directly in the tech space or whether they're kind of regular businesses that are kind of thinking about their strategy into the midterm and how they need to adapt and adjust their headcount, may well kind of be making some big headcount cuts soon and then reinvesting later. And actually that would fit with the big survey that Bloomberg Intelligence did at the back end of last year, where corporates said in the mid to long term we actually don't see our headcount reducing that much, but we are making lots of short-term tactical reductions in our headcount as we reposition for that future growth opportunity.
Tech still has jobs in tech, which is
You have to wonder to what extent the US is the canary in the coal mine because of the proximity to the AI innovation and the looser labour laws, and whether we watch what happens in the US and then we start to see that 12 months down the line here in the UK.
12, 24 months, as you say, labour laws I think are a really important factor here. If you think about Europe and how difficult it is to make people redundant, say in France or Spain, and that's going to be a big issue, and I think certainly some governments will take a different approach to how you treat people.
Matt, thank you very much. Matt Bloxham, Bloomberg Intelligence analyst covering tech for us. Coming up on the programme, we will pivot back to the big geopolitical story of the moment. We'll talk to Kasra Aarabi, IRGC Research Director at the United Against Nuclear Iran. That's as President Trump calls for a clean-out of Iran's leadership. Certainly wants to have a role in who comes next in terms of leading the country. That conversation is here on this programme coming up shortly. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. It is day 7 of the Middle East war, and the European stock picture looks like this. Green across the screen this morning. We are seeing US futures pretty flat, which is usually the sort of picture that we would see on jobs day. But of course, the war is dominating today. Tom, what are you seeing under the hood when it comes to Europe?
Yeah, how much positioning do we want to be putting on ahead of the weekend, given what could change, of course, over the next 48 hours or so? So volumes are a little lighter, possibly in that context, down about 25% over and versus that 20-day average. On a member-by-member breakdown, so you do, of course, have the majority now of stocks in this modest risk-on environment in the session today, actually higher, 416 versus 168 to the downside. Let's flip the board and have a look at some of the individual names and stories playing out then. Interesting, it's travel and leisure near the top of the list in terms of sector basis, industrials as well, into which, of course, defence sits. So Rheinmetall up 3% on the back of that expectation, of course, that defence stocks will perform better and get some upside as a result of the war in the Middle East. SAP, a third straight day of gains, interestingly, for this software company with the enterprise focus, up 1.8% so far. It's been challenged, of course, because of that AI disruption story, but in the week, SAP is looking a little brighter. Lufthansa, that is the lift across the travel and leisure space then, with the airline coming through for some pretty positive remarks in terms of how they could benefit longer term as they adjust some of their routes. Up 3.4% then, the German airline gaining in the session today. On the downside, let's flip the board, and in the pharma space, Roche is challenged. Zealand dropping very significantly as well in terms of an obesity drug and disappointment there, failing to clear a high bar set by Wall Street. Roche and Zealand partnering on that. Roche down 2.8%, but Zealand, look at that, plummeting. That Danish company down 31%. In the semiconductor space and the chip space, interestingly, some mixed picture in terms of the details coming through this week. Broadcom very positive in terms of revenues coming through. Marvel with an upgrade to the forecast, but maybe this is a supply chain story. BE Semiconductors currently down 9.4%. The Dutch company taking a big hit in the session today. Anna.
Tom, let's get an update on some of the other stories we're covering this morning. President Donald Trump is facing a major legal challenge to the global tariffs he imposed last month after the Supreme Court struck down his earlier sweeping duties. President Trump's proclamation placing a 10% tax on imports as of February 24th is, quote, fatally flawed and must be overturned. That's according to the 24 states who filed a lawsuit yesterday in the Court of International Trade. Trump has said he plans to increase that levy to 15%. Bloomberg has learned that SoftBank is seeking a loan of as much as $40 billion to help finance its investment in OpenAI. The potential size of the loan underscores founder Masayoshi Son's aggressive bid to try and position his company as a linchpin in the global AI boom. And the US has cleared the way for India to temporarily increase its purchases of Russian oil, reversing months of pressure on the world's third largest crude importer. The waiver, which expires on April the 4th and is intended to enable oil to keep flowing into the global market. Let's pivot our coverage back to what's happening in Iran. And a barrage of Iranian missiles and drones has targeted at least 5 countries across the Middle East. This as Israel carried out a 12th wave of airstrikes on Tehran. The Iranian Foreign Minister Abbas Araghchi told NBC News that his country hasn't asked for a ceasefire and had no intention of negotiating.
And we are prepared for any other eventuality, even, a ground invasion. So our soldiers are prepared for any scenario. When I said we are waiting for them, it didn't mean that we are waiting for continuation of the war. No, but we have prepared ourselves to confront with any scenario, with any eventuality, any possibility, and we know that we can handle that.
For more, we're joined now by Kasra Aarabi, who is director of the IRGC Research Unit at US-based non-profit and non-partisan policy organisation United Against Nuclear Iran. He was previously the Iran programme lead at the Tony Blair Institute for Global Change. He's also been a non-resident scholar at the Middle East Institute in Washington. Welcome to the programme. Thank you very much for joining us, Kasra. Can we talk about succession and what that looks like in Iran? Help us understand a little what we should be watching for here. We hear lots about resilience in succession and resilience in the regime in Iran, but then we hear President Trump wanting to insert himself into the conversation about succession. Who is in charge of succession now, by your estimation?
So we've got 2 things here. We've got the visible state, where everyone is paying attention to, but actually behind that we have an invisible state, a hidden power structure. Ayatollah Ali Khamenei, who was eliminated, the supreme leader, he had created this hidden power structure, the office of supreme leader. It wasn't really an office, it was an extensive apparatus that enabled him to A, make sure that he has eyes and ears all over the regime's elites, but B, more importantly, ensure that should he be eliminated, the Office of Supreme Leader, the Beit, made up of as many as 44,000 affiliates, can ensure continuity rather than confusion. So the Beit, his former office, the Office of Supreme Leader, alongside the IRGC, that's the Islamic Revolutionary Guard Corps, the terror army of the regime, behind the scenes, they are ensuring that there's no power vacuum, and they're the 2 bodies really deciding, alongside with the clergy as well, of course, deciding who's going to succeed. In that Office of Supreme Leader, crucially, Mujtaba Khamenei, the former Supreme Leader's son, second eldest son, he's operated as a bit of a mini Supreme Leader in that structure already. He is tipped to succeed his father now.
OK, so for what you've said there, that sounds like the process as the Iranians would like to see it unfold. are there other players that we need to be aware of who sit outside the regime, whether that's the theocratic regime or maybe parts of the secular state? Any other leaders that we need to be aware of that the West might be interested in giving more power, allowing more power to?
Well, there's no secular state. This is a totalitarian Islamist dictatorship. You don't have
there's
any
the theocracy, but then there are elements that look from the outside, like presidencies,
and that's an incorrect external observation. This is an Islamist regime. To be able to even stand a chance of being a candidate, even at council level, you have to be an Islamist. You get checked. There are extensive vetting processes. You have to pledge full commitment, practical commitment to absolute velayat faqih. Absolute velayat faqih means absolute rule by the supreme leader. Ordinary Iranians cannot participate in the political process. You have to not only be a religious Iranian, a religious conservative Iranian, but you have to prove that you are an Islamist. You undergo extensive ideological indoctrination. So there's no... You're referring to the visible state, the presidency, the conventional apparatus, but even in that conventional apparatus, they are all Islamists. So if we take a step back, though, the most important in the long term here, in the short term, the most important player that we haven't mentioned are the Iranian people. Let's not forget, last month, they took to the streets in their millions. They have been taking to the streets, by the way, continuously since 2017. The protests that we saw, they weren't a flash-in-the-pan moment. This has been reoccurring. The message of the Iranian people has been clear. They want regime change. They no longer want to live under this dictatorship. Last month, they took to the streets, and this regime massacred as many as 40,000 unarmed civilians. Yes. And that's why the response has been, from the Iranian people, positive to the strikes that are ongoing.
What is the mechanism for the Iranian people taking charge then and avoiding a Libyan scenario where you get a civil war?
First of all, Iran's very different to Libya. Libya is a very tribal, was a tribal, and is a tribal society. Iran's community, Iran's society, the different ethnicities that have been living together side by side, have been living together for 2,500 years. So it's not a new nation. Iran is one of the oldest civilizations in the world. For the Iranian people to be able to take control, reclaim their country, this is what they believe. They want to reclaim their country. Ultimately, the suppressive apparatus of the Islamic Revolutionary Guard, called the IRGC, there's an extensive apparatus that pervades every level of society. That needs to be dismantled. Right now, in the phase one of this military operation, the US, the Israelis are focused on decapitating the offensive and defensive capabilities of the regime. But we are starting to see them going after dismantling this suppressive architecture.
Well, Israel's trying to bring in the Kurdish forces. How risky would that strategy be?
I think we need to take a step back, first of all, and say, for Iranians of all ethnicities are united in toppling the Islamic regime. That's been consistent. We saw that in the protests. There was no sectarian or ethnic tension. Iranians are united. They've lived together. These different ethnic groups have lived together. Actually, Iranian nationalism, this pluralistic Iranian nationalism that involves Persians, it involves Kurds, it involves Iranian laws, it involves the Azeris. That's the most powerful weapon against this Islamist regime. Any move that is perceived by the Iranian people that Iran's territorial sovereignty could be at risk, that risks fracturing this unity and actually emboldening the regime. So if there is a strategy whereby, and we don't know yet, these aren't confirmed reports, the US has actually denied this, but if these reports are accurate, I think it needs to be equipped with a very, very clear communication strategy that says and speaks to the Iranian people and says this is merely a tactic to draw the IRGC to the battlefield so that we can enable the Iranian people to take to the streets, provide them with this space. This isn't an attempt to divide Iran, because that is the Iranian people's red line, and that would embolden this regime.
OK, so some caution there. Thank you very much. Thanks for joining us, Kasra Aarabi, Director of the IRGC Research Unit at policy organisation United Against Nuclear Iran. Now, the current intensity of the Middle East war is unlikely to endure That is, apparently, if you do some analysis of stockpiles, Iran could exhaust its missile and drone stockpiles, while Israel and the Gulf may face pressure on their missile defence systems. Let's try and get into some of the numbers and talk about this. Jerry Doyle joins us, our global defence editor. Good to have you with us, Jerry. So from your research, from what we know about the stockpiles in the various locations, how long can this conflict last at the sort of current usage rates?
I mean, I am not sure there's any way to definitively put a time horizon on it. At the beginning of the war, the outset of the war, Iran was estimated to have something like 2,500 ballistic missiles and a much larger number of these Shahed one-way drones, sort of basically a rudimentary cruise missile. Since the war started, the U.S. and Israel have targeted not just the missile stockpiles, but the missile launchers, which has created sort of a bottleneck to using the ballistic missiles. If you don't have the launchers, it doesn't matter how many missiles you have in your stockpile, they're just going to sit there, right? And so we've seen that since Saturday, the volume of Iranian ballistic missiles has sort of tapered off a little bit, although there was a big uptick yesterday. The drones, on the other hand, have seemed to increase in volume. And so there's some indication that Iran has a large number of these. They may be producing them. And so that's why it's unclear, whether we can put a definitive horizon on how long the conflict could last. A high-intensity conflict with large numbers of ballistic missiles, we might be past that phase in a week or two. But a sort of enduring conflict with these continual strikes around the Gulf using the Shahed 136 drones, that could continue for a longer period of time. And then on the U.S. and Israeli side, they have been using many of these higher-end air defense weapons, the Patriot PAC-3, THAAD, even SM-3 Block 2A is launched from naval ships to intercept ballistic missiles, but also because of the sheer volume of these drones attacking to destroy them. And so you have this mismatch between a very expensive interceptor and a very cheap missile, and it's causing those stockpiles to run dangerously low.
So, Jerry, if they're using those high-end missiles on Iran, how exposed does that leave the US to the likes of China?
At the moment, as far as I understand, the U.S. has not had to pull from stockpiles in the Indo-Pacific region. If it does, I think there introduces sort of a theoretical risk against a ballistic missile attack. However, China has the world's largest conventional ballistic missile arsenal, has large numbers it can concentrate on any one target, and so the actual operational impact might not be that high, just from a cynical point of view that China would be able to, if it wanted to, concentrate all of its ballistic missile fires on one target and get through.
Thank you. Thanks very much, Jerry. A lot to digest. Jerry Doyle, our defence editor, Bloomberg's global defence editor. Thank you for joining us.
Well, coming up, the smartphone industry faces pressure from chip shortages amid the rising geopolitical risk. And we'll be speaking to Carl Pei, CEO of consumer electronics company Nothing. That's next. This is Bloomberg.
Welcome back. Now, London-based consumer electronics firm Nothing is introducing a new range of devices at a time of growing pressure on the global smartphone market. AI-driven demand for memory chips is tightening supply across the tech sector, while escalating tensions, of course, in the Middle East are adding fresh uncertainty around shipping costs. Joining us now is Carl Pei, CEO of Nothing. Carl, good morning. Thanks for joining us in the studio. We're going to get to the launch of the phone, of course, but in this moment that we are currently living in, with all the concerns and implications of the war in the Middle East, to what extent are supply chain challenges impacting your business at this point?
The supply challenge that we've seen in our industry is more around the memory, not around the war. Like all the AI servers, a lot of the memory is bought up by AI, so that for all consumer electronics, including phones, laptops, and anything else that has memory, the costs have really gone up this year.
And you're an upstart, and you're making challenges, and you made some pretty significant inroads, but you are, of course, still in that upstart position. Does that make it harder in terms of negotiating supply? What does it mean for pricing? Do you have to pass on that cost to the consumer?
I think about it this way, right? So there's different companies in our industry operating at different price points to the consumer. The more differentiated you are, the higher price you can charge. And the higher price you can charge, the more you're sheltered from supply chain shocks like this. So the low-cost players are the ones that are going to be really impacted. When you ask our users why they buy our products, design, user experience, software, and brand are like the top reasons. So we're a little bit more sheltered towards this. But just to illustrate as an example, last year about 15% of the cost of building a phone was memory. This year it's 40% for us.
So you've got enough memory in reserves?
We have enough memory, but the costs have gone up.
Yeah, because analysts are warning that shortage is going to extend to 2027.
Most likely.
And you've got the IDC saying that there'll be a 13% decline in the smartphone market. Is that about right in your view?
It's very early to tell. We're early into 2026 right now. I think consumers will be shocked when they see all the new launches at a higher price. But these are also products that you need, right? 1 billion phones are sold every year. 5 billion phones are used actively.
You don't need an expensive one, though, Carl.
Huh?
You don't need an expensive phone.
Well, we have phones in all kinds of price points.
So you talked about the fact that the cost of the memory is going up. I mean, what does that do to pricing? Does that mean that you have to charge more? Are you going to have to charge more?
Well, some companies are going to absorb the cost in their margins. Some are going to charge more. It's most likely going to be a blend of both.
And you say that the people will pay up for differentiation. So, and you listed the reasons why people might buy your phone. I mean, I could think of lots of tech products that people would apply those same reasons to. So what is it that differentiates yours?
Well, we're targeting the young and creative. That's where we're really finding a lot of resonance, and we're targeting them through very differentiated product design and also a software experience.
This is the foray that's just been launched.
Yesterday, yeah.
What are your ambitions for shipments? How many units are you targeting at the foray?
We're not talking about exact shipment numbers, but I can tell you that we're the fastest growing smartphone brand in the world, and we approached $1 billion in revenue.
That's because the others are really big.
Yeah, correct.
But you know, there's a big market to go after.
Carl, what is your ambition with? I mean, Tony Fidel's an early investor and as a backer, and he helped co-design and co-invent the iPhone and the iPod. What is your long-term ambition? What does the business look like in 5 years? How much market share do you want to be taking?
I think that's not the most important thing. You know, as a kid, I was really inspired by all these tech products that were coming out, the iPod, the iPhone, etc. It felt like every year these products got better and better. And then as I grew up, it got more and more boring. Products became more and more iterative. So I wanted to bring that fun and inspiration back into the industry. And so hopefully for kids growing up today, they also have a company to look up to. And I think we can begin to make a mark in the industry, not only making products that have already been made by other people, like phones and headphones, but also beginning to bring our own innovations to the market.
But come on, I've read that you want to be $1 trillion company. Do you want to be the next Elon Musk?
No, I just said that, it's an infinite game. I'm going to do this for as long as I can, maybe until I retire. And it's not really about the money.
Do you have to think carefully about production locations, manufacturing sites these days? We started off talking about the supply chain issues, which at the moment are all about AI, and they're not necessarily about security and geopolitics, but it's very easy to see instances where geopolitics interferes with your ability to get supply or product. I mean, do you have to think carefully about that? You manufacture in China?
That was more like a topic for us in the beginning when we just founded. We manufacture in China, we manufacture in India. In fact, we do more in India than we do in China right now. But these days we have that pretty much figured out, yeah.
How do you think embedded AI evolves? What kind of devices are going to be? How central is the smartphone going to be to us in an embedded AI environment?
I think the smartphone is going to be the most important device in the AI era as well, because, there's no other device with this much context on us, right? So the basic logic for AI is the more data it has, the more it can help us, the more it knows us. So there's no other device with this.
It doesn't shift to glasses. It doesn't shift to earbuds. It doesn't shift to something on your lapel.
However, the phone is not always going to be available, right? Sometimes we're walking around. Sometimes we're at a dinner. We don't want to have the phone on the table.
Yeah.
That's when the use for other form factors will emerge. You got to have other types of products to keep.
Are you
capturing.
working on some of those form factors?
We are, yeah.
You said that you want nothing to be ready to potentially IPO by the end of 2028. What's stopping you committing to London?
We just haven't really thought about it. And we said, let's be ready internally. Doesn't mean we do it. We look at the market conditions and decide whether it's better to go private or go public if we need more financing. But I just wanted our team to get the house in order by the end of 2028.
We have a question from a viewer, Carl. Are you looking into foldables So Apple's been very slow to this. We've had foldables in China for years. My Chinese friends, they've all had foldable Huaweis and Xiaomis for a couple of years. Is that a place for you as well, or do you steer clear of foldables?
Well, if you think about it this way, the smartphone market is 1 billion units a year. Foldables is less than 20 million out of that billion. And the average user for the foldable is like a man doing business in his 40s. We're targeting the young and creative consumers, so it's not a great fit for us.
Your demographic.
I think that's a no.
He says, looking at me. Thanks, Carl.
Well, Carl, you suggested that I wasn't part of the younger market that you're targeting as well. But Carl, good to talk to you.
Thank you.
Carl Page, CEO of Nothing. Well, let's have a look at what else we're watching throughout the day. The Canadian Prime Minister Mark Carney is in Japan, so we'll listen to him there. At 10 a.m. London time, we get Euro area GDP numbers. Before at 1:30 p.m, we get, of course, the US jobs report with non-farm payrolls and unemployment in focus. And then at 5 p.m. London time, we'll hear from the ECB's Isabel Schnabel speaking at the Monetary Policy Forum in New York. How much hawkish is she in the environment of the Middle East war? We'll also hear from Fed speakers Daly, Paulson and Hammock at that same event, Tom.
And Bloomberg will have interviews with the Fed Governor, Chris Waller, Cleveland Fed President Beth Hammock and Chicago Fed President Austin Goolsbee later today. Really important to hear from them, given the repricing we've seen around central banks and, of course, the Fed as well, Anna.
Yeah, the Fed in focus, jobs market in focus later on, headline risk after the Middle East. Certainly in focus as well. Let's think, it is Friday, it is just coming up to 9 o'clock here in London, so let's think about the weekend ahead. And we're fully aware that we have plenty of viewers in the Gulf for whom this might seem a little out of touch, but we all hope that these events can act as something of a distraction from everything that's going on in the world. So let's talk about what is happening this weekend. We have Grand Prix in Melbourne. That is taking place. Some difficulty in getting there for some of the teams. We understand there's rugby. Where's Guy when you need him? Tom? No. Over to you on the rugby? No,
Ireland-Wales. So Mark Cardinal's going to be tuning in for that. That's at 8 later today. Ireland versus Wales. That's going to be a good one. Italy, England. England's performance has been pretty mixed.
Moving on.
Sam Etienne, our executive producer, will have views on that. That's at 4:40 tomorrow. But I know you're particularly interested, guys, in crafts.
In crafts. I was going to the Fashion Week.
Oh,
that's for Lizzy.
Can I pick out the highlights of the weekend? You've got today Mugler and Loewe and Givenchy.
Tomorrow you've got the right team assembled.
And Hermes. And then on Monday, Chanel.
Speaking of the weekend, be sure to catch up on Bloomberg, the Bloomberg Weekend newsletter. That brings you a collection of interviews, ideas and stories to explore the fascinating places where finance, life and culture meet. No doubt they have some incredible context on all that the world has been witnessing over the last 7 days or so as well. So certainly that's something to tune in for. And Bloomberg TV over the weekend is also available to you. That is it for the opening trade.
European stocks are up on the benchmark, up 0.5%. US futures pointing to modest gains of 0.1%. That is it for the opening trade. The Pulse is up next. This is Bloomberg.